A shareholders agreement is every business's very own prenup. A business hopefully never needs to see the value of it, but as a lawyer, you need to know it, draft it, and make the best use of it in times of need. It is like the basis of everything that the company and the relationship between the partners is about. And God forbid, if a dispute does arise, you will certainly look back on today and thank us for the session we have in store for you. Hello, everybody, and to start with, thank you for so much support. We are 1100 plus participants strong today. All thanks to you guys. Joining us today is the same person who let me do this, and because of whom all of you are a part of this beautiful saga called An Hour with LawSikho. Welcome to An Hour with LawSikho, and please allow me to welcome the super amazing Abhyuday Agarwal on today's episode. Abhyuday, welcome on An Hour with LawSikho.
Hi everyone, thank you for being here. And I'm really excited once again, as I'm on every Wednesday, to have a session with you.
All right, Abhyuday, today we are discussing things about shareholders agreement. We have a lot of viewers who probably are, still in the very inception of their law school and who might not know what shareholders agreement is. So let's just start with giving, if you could just give us a basic idea about what a shareholders agreement
Sure,
is and what's its value.
sure. Aditya, should I put on earphones? Will that be better for you?
This works fine as well, so whatever suits you.
Okay. So when you read company law in law school, whichever year it is, third year, fourth year, fifth year, you start with the memorandum of articles and memorandum of association and the articles of association as being the prime constitutional documents of the company. So your memorandum has only around 6 or 7 clauses which say what the company does, the name of the company, the registered office of the company, and all of that. Okay? And it's a pretty straightforward, cut and dry document. The articles of association, on the other hand, have a huge amount of detail on how the affairs, everyday affairs of the company are going to be governed and how key business decisions are going to be taken. So for companies, key business decisions could mean various things, such as issuance of capital, because expanding and raising money is one of the key aspects of a company's growth. Taking loans, changing business verticals, starting a new vertical, changing a product line, all of this, initiating a litigation of a certain amount with somebody, against somebody. So your articles of association will govern everything technically. Okay. Now the Companies Act provides you a format which is the default format which you will use for your articles of association, and that is how all companies begin. When you start your company, most of the time you will not go to a lawyer and you will go for a default. You will adopt the default articles of association, and your CA will advise you on that, and that's how it starts. Okay, and that's great to start with, and you have a lot of flexibility to do certain things uh, based on how you decide, how you and your other shareholders at the board level decide things. Okay, but when you decide to you decide to raise capital at a professional level, you will need to have an agreement on each of these things in a lot more detail than you were earlier doing under the articles of association. So what is done at that stage is that the investor enters into a shareholders agreement with the founders of the company and the company, which determine, so it's the share subscription, share purchase, and shareholders agreement. A lot of times these three documents are compressed into one. Okay, but one of the key parts of it is the shareholders agreement, which will define the rights and the everyday governance procedures, the limitations on the powers of each party, all of that. Okay, and based on this, once the investment documentation is signed and the money comes in, the articles of agreement of the company will be amended to reflect the shareholders agreement. So the entry to any investment transaction at a professional level is a shareholders agreement. You use a shareholders agreement when you raise investment, when you get any other shareholder on board, which could be a friend whom you want to take in at a co-founder level, or you can also use a shareholder. So private equity investments, again, you use a shareholders agreement. Joint ventures to use a shareholders agreement. Okay, but the nature or some of the terms of the shareholders agreement can be different in case of joint ventures. Okay, that's the commercial part, and you need to know the commercial part But corporate law wise, it's the same.
All right, Abhyuday. Abhyuday, can you just say that a shareholders agreement is an extension of the Articles of Association every time a new investor joins in the company in a more detailed and descriptive form?
You can say that a shareholders agreement is the entry, like whenever you have an investment at a professional level, you need to have a shareholders agreement that defines the rights of the shareholders. And then
All
your
right.
articles will reflect it. Maybe 90%, 100, usually 100% of it is incorporated of the shareholders agreement is put in the articles. So that the obligations are statutorily binding, not just by contract, but by statute, because articles are binding on the company as a contract and under the Companies Act as a statute.
All right. Abhyuday, the next question that I have from you is that a lot of law students and a lot of law schools do not really teach the relevance, the importance, and the drafting of a shareholders agreement.
Okay.
What is the importance and what gives a law student an edge if they learn things about shareholders agreement and if they learn how to draft a shareholders agreement?
Yeah. So we've discussed in some of our earlier sessions about this aspect of commercial intent, and that basically means specific commercial goals and jargon that is used with respect to a business transaction. So now law schools don't teach that, okay? And learning that for shareholders agreements can be a real lifesaver. Also, if you don't learn it in a structured way, it takes you ages to learn. What happens is that you may be a batch topper, you may be doing really well, you may have interned a lot, and you end up getting a great law firm job, okay? Even then, the kind of agreements you get exposed to, they are like huge, 150 pages, 200 pages. So you are actually reverse engineering the process, and you're reverse when you're trying to learn it, and when you're reverse engineering from its most complex form. Okay, rather than building your knowledge from the building blocks, you're doing it the other way around. So it gets really complex. And for me also, when I started working at Trilegal, I could understand a lot of clauses, but I couldn't understand the commercial intent behind it, which I started understanding only when I started preparing the study materials and asking questions to experts, for myself, looking at books, speaking to entrepreneurs, speaking to investors, all ways around. Okay. And I realized I got a lot of business insights which you don't otherwise have. And that enabled me to understand the shareholders agreement much better. Now, so how do you get to learn this, or what's the importance of learning it early on or during law school? It is extremely important to learn it during law school. The problem is that it is one of the more complicated and detailed contracts. So you need to get to the basics of contract drafting first, and then you can move on. Like right now, we are doing an exercise with our interns who are currently in iPleaders Delhi office, where they are looking at 90 different kinds of contracts, and these are from much simpler contracts to little more complex forms. Okay, and that's enabling them to splice through a contract and understand what is happening behind the scenes, because a contract is never written, it is not always written in the most reader friendly manner, right? So when they have the practice of going backward from the simplest contracts to more to bigger contracts, then they can construct a more difficult contract much more easily. Okay, so the way to grasping a shareholders agreement actually goes like that. What a lot of people do is they jump right to the most complicated version, but you can't then piece it together.
All right. Abhyuday, you talked about commercial intent behind a contract, and in fact, I very well remember when I was interning at one of the places where I had to draft a lot of contracts. The very first thing that my then manager told me was that you need to understand the intent behind a contract. Every contract has certain intent. What are the various intents that are involved in a shareholders agreement that a person or a drafter needs to know about?
Okay, this is a good question. So let's start with the intent of the investor. Okay, and most of the times a mandate will be there to draft an agreement from the investor's side. The investor's lawyer will prepare the first draft, and the investee may engage a lawyer, but it will mostly be to negotiate, finalize the terms. First level drafting will be done by the investor's lawyer. Okay, the investor's interest is that their money needs to be safe and it needs to grow. So what do they do to keep it safe? If they invest in equity shares, the problem is that you have to take risk because the value of equity can go all the way down to zero, right? So they have a number of clauses to protect that. They use something called convertible debentures or convertible preference shares, which means that these are not equity shares to begin with, but and so till they are not equity shares, they will have the characteristics of debt. What does that mean? That means that you will get a fixed interest. Okay, you will get a fixed interest on the passage of every year. And in the case of preference shares, it can be that your fixed interest is paid only if the company makes the profit. Otherwise, it just accumulates and it will be paid later on. Okay. Now, these are actually redeemable, which means the company has to pay you the full money back if it's a debenture or if it's a preference share. But then investors want the upside, right? They want to, if your company grows in value, then they want to have a stake in that. So if you just pay off their loan with interest, that doesn't feed their hunger. It's the same reason why everyone invests in real estate. You get rentals. You could have put that money in an FD and gotten interest. But the money that you can gain from the appreciation in the value of the property, that is the upside. And that's what investors want. So they will want to have the upside of equity, and they will want to protect their downside by using some characteristics of debt. The way they do it is by having a convertible preference share or a convertible debenture. These can be compulsorily convertible, which means they'll mandatorily convert or they may optionally be convertible. We'll get into that later. Let's focus now on the commercial intent part, right? So that way they are hedging their downside. The other way they hedge their downside is one, by controlling, to an extent, controlling or preventing certain actions from being taken. That is called affirmative voting rights or affirmative voting rights or reserved matters. There are certain items in any shareholders agreement which say that any decision that you take on these matters must need the investors' approval. Okay, so that means that they can prevent you from using money in a certain way which they don't approve of. Okay, but that is if so you don't have 100% flexibility in using the money the way you want to, but you do have a lot of flexibility. Okay, the third thing is, how do they exit? Okay, and what happens in an exit situation? So investors have tried a number of creative things with that. One is specifying an internal rate of return. Internal rate of return is, in simple terms, like a form of interest. That if I invested 100 crores in your company, then after 5 years, if I'm exiting, I want 20% year on year internal rate of return, which means that my return has to compound 20% year on year. Okay, that's the money I want when I exit. Now, whether it is legal or not, and sometimes RBI starts objecting to that, because if you say that I want minimum this much gain, then you are not treating it like equity, right? Now, that's what happened in the NTT Docomo case, where in the Tata Docomo case, where Docomo was exiting from the investment and Tata was to pay a certain amount to them. Okay, RBI objected, saying that this payment is not authorized, not in consonance with FEMA. That wasn't ultimately upheld. Okay. Anyway, so how much they get at the time of exit is important. Can somebody else? So they have a certain percentage when investors invest, right? Now, can somebody else uh, get shares without the investor getting shares? If that happens, the investor's percentage shareholding dilutes. So if the investor had 20 shares and the company had 100, company is free to issue shares to others. If it issues 20 more shares, the investor will have 20 out of 120 shares, which gives them some 4% less shareholding. So they don't want that. So they have certain rights for being offered shares at a preference to any third party. Only if they can't take that up, can you go to a third party. Okay, and at a better rate. Then these are clauses like right of first offer and right of first refusal. The other is when founders want to exit, investor want a tag along right, because an investor is a minority shareholder And if a minority shareholder is left and the majority shareholder is gone, then nobody will want to buy the minority shareholder's stake. So the minority shareholder has to stay behind the majority shareholder. The other side of it is the drag along right, where they say that if we get a buyer, the buyer will want to have control. So we are going to pull you with us. So there they have a rope on the founder that we'll take you with us. So this protects their exit. Okay, these are examples of rights. Another right they have is, for example, they will say to founders that you will stay completely invested in the business. You full time you will work here. You will not do something else. You will not dilute any of your shares. Okay, these things are for ongoing protection of their investment and for clarity that the founder is really committed to the company. But listen, at the end of the day, if the founder doesn't want to be committed, then there are various limitations in being able to enforce it. Okay, but anyway, let's move on. So this is a framework I'm giving. Okay,
So,
and
Abhyuday,
they
this
have a
is
liquidation preference also, which means that if there is a exit situation, then the investors may get a certain kind of preference over the founders. We'll come to that when your question comes.
all right. Abhyuday, you spoke about this. These are the various investors' intent. Are there any other parties' intent involved in drafting a shareholders agreement as
Founders'
well?
intent is very important. What do founders want? They want the money. They want to dilute less, which means they want to have majority and they want to give the least stake, least percentage of shareholding for the maximum money possible. Okay, so that the value of the startup is high. So if I raise 100 crores and give only 10%, the valuation of my startup is 1000 crores. But if I raise 100 crores and give 30%, the valuation of my startup is around 300 crores. Okay, so any founder will want to take the maximum money, give the least percentage. Okay, so we'll want the maximum valuation. They'll want the most freedom to operate vis-a-vis spending the money also, and they will want the least restrictive governance. So they will want to have the freedom. They might minimize or reduce the scope of affirmative actions which require investors' approval. Okay, they may negotiate on the extent to which they can dilute because founders want to earn money, right? Now, after they have needs, they have aspirations. The reason they started the company was to make a difference and earn gain and upside. So, what happens with investors is that after you have an investment, the investor can freeze your dividend policy. It can freeze. It is also freezing what other work you do. Because the investment agreement will say you can't do other things. Then it will freeze whether you can sell your shares, and they will have an employment agreement with you, which actually makes you only take salary. Okay, and it will be performance linked. So which means that founders are completely with a blinkered vision. You have to grow the company, and there are very limited ways in which you can take this money out. So a founder wants to have certain options that, okay, if I need cash flow, I should be able to dilute a little bit of my shareholding and raise cash. Okay. In an exit situation, there are certain rights which can be disproportionately beneficial to investors, which a founder will want to have some kind of balance on. Like a liquidation preference says that if the investor is exiting, okay, and investor and founder are both making money, then vis-a-vis both of them, investor will get a certain amount extra such that its liquidation preference is met. So let's say the investor came in at 100 crores, and at the time of exit, the valuation of investor's stake is 150 crores and founder's stake is 300 crores. Okay. But what the investor will say is, look, boss, I had a 20% internal rate of return clause. As per that, from 100 crores, I should have got at least 220 crores. So I'm getting only 150 right now. So I need the balance 120 from somewhere. So whatever exit price you are getting 300 crores. So your 300, say I'll take extra 120 and you will get 180. Okay, so founders upside reduces, investors upside increases because of that clause. So these are the kind of things that founders intend and need to negotiate.
Abhyuday, this is an uncalled for question, but given the fact that a company is a separate entity, does the intent of the company also matters in a shareholders agreement?
The intent of the company, I think,
separately.
yeah, I think it is very well articulated. One, by the founders because they want certain autonomy to grow the business, and secondly by a certain level of regulation that the investors place on the business. Steve Jobs, in the time of Steve Jobs, it was called adult supervision, right? So I think the mix of both of these actually works for the benefit of the company.
All right.
Separately
Abhyuday,
doesn't need something else, in my opinion. Okay.
okay. Okay. So Abhyuday, the next question that I have from you is that you said that the basic idea of anybody, be it the investor or the shareholder, is to maximize return and minimize the downside. What are the important terms in a shareholders agreement that ensures that there is a that there is a return maximization and downside and minimizing the downside?
So we started with this thing, right? Let's list them down. Uh, there is there is an internal rate of return clause which says how much money they will make. There is an affirmative voting rights clause which says which decisions cannot be taken without the consent of the investor. There is an anti-dilution clause which says that if you issue shares to anybody at a lower valuation than the valuation at which the investor invested, the investor is going to get certain shares at a cheaper price. So if the investor invested at 300 crores valuation and after that you raise money at 200 crores valuation, you will adjust the investment of the investor such that he would have invested at 200 crore valuation. How do you do that? You simply do that by giving additional shares to the investor at a lower price, okay, or free. That depends, like how it works. There is a then there are preemption rights, which means any new shares will first be issued to the investor. Like investor will have the option to take the new shares. That's when the company is issuing shares. There will be rights to prevent when the founders are selling shares. Okay, so founders will have a lock-in. Firstly, they will not be able to sell their shares for a certain number of years. And investors' drafts can have clauses like they can't sell any shares till the investor holds any amount of shares in the company. Which means if a founder has 60% shares and the investor has 30%, investor can say that till I have even 1%, founder cannot dilute even one share. Founder cannot sell even one share. So those kind of things you have to watch out for. So there's a founder lock-in. There's a clause which says founder will work full time, will not work in any other business, will not compete. That is there. There's a tag along right, which says that if the founder wants to exit, then investor has to be tagged along with it. There's a drag along right, which says that if there can be or cannot be, depends. Okay, if the investor finds a buyer, then it can compel the founder also to sell founder shares so that the buyer can get control, and that way there is a better chance that the investor can exit than by exiting alone. Okay, because there might be some buyer who wants full control of the company. What will he do with a minority share? Okay, there is a right of first offer clause if a founder or it could be a right of first refusal. There's a minor difference between them. If the founder wants to sell his or her shares, then first person to approach is the investor. Okay, and only if investor is not able to buy at the price that the founder wants and founder finds another buyer who's buying at a greater price, then their shares can be sold. But this only gets activated once your lock-in and other requirements have expired, because the founder lock-in prevents you from selling your own shares. So right of first refusal question only doesn't arise. Okay. uh, then there was a liquidation preference clause which said that in the event of an exit situation, it will be ensured amongst between the founders and the investor that the investor gets the IRR that he or she wanted. Okay. The legal validity of these clauses can go up and down, okay, depending on if there's a regulatory issue, if there is foreign investment, all of that. Sometimes company law issues can be there. There is a personal indemnity from founders sometimes. Every investor's draft has this, an indemnity that any losses or any failure to satisfy the IRR will be personally borne by the founders. This completely collapses the structure that a company is a separate entity. right? Because the founder is now required to pay the money that the company owes to the investor. So most founders need to negotiate it out, and indemnities need to only be paid from the money of the company, not personal money of the founders. Otherwise, founders will end up getting bankrupt because of the volume of investment involved and the kind of return investors want. Okay. These are some of the clauses. These are the most important clauses.
All right. Abhyuday, the next question that I have from you is that how important are profits for an investor, and what are the
How
various
important are what?
how important are the profits for an investor, and what are the various instruments of maximizing such profits?
Right. So you have to see who the investor is. If you have an angel investor who invests his or her own money, while it's someone's own money, they may have a long-term vision, and they don't have a legal obligation to pay someone off at some point in time, right? So they may have as long as the company is doing well, they'll be more patient with it. They will want to mentor the founders a little more, okay? But a lot of if you raise professional investment, which is venture capital uh, or private equity, Series A, VC onwards, some entrepreneurs call it that way. That's what it's known as the deals in the deals circuit. So in that case, sorry, what was I talking about?
About it's,
Just
you're
repeat the question again.
sorry.
Just repeat the question.
We were talking about Abhyuday that how important are profits for an investor.
How important the profit is. So for
Yeah.
VC and PE funds, they are actually a fund, which means somebody else has contributed to their money. They don't have that much of their own money, and they are obliged to give them their investors a certain amount of return. Okay, and which has to be at a high amount because venture capital and private equity are risky investments. The riskier the investment, the higher the amount of return you need to promise. Otherwise, people will not come to you, and they will instead put money in FDs or in their savings account, right? So they need to promise a high level of return, and it's time bound. So the life cycle of most funds is like 7 to 10 years. Okay, 10 years also longer. Mostly it's 7 years. In that period of time, they have to actually return back the money to their investors, which means that there's a huge amount of growth that a startup needs to establish in that much time to actually be able to return the investors' money. Okay, so profits are, I would say, growth in investment is critical. So profit may not be for the company, but profit in terms of the growth in the valuation, which is there, is very important. Performance of the company has to be good. That may not correlate with the profits of the company because there are many companies which may grow in valuation and not have a revenue stream. Although that doesn't work so much in India. In India, the concept is entirely different. In US, you have these kind of businesses which are tech driven, don't have profits, but don't have even revenues, but based on users, they can have a valuation. In India, it doesn't work like that. You need to have at least revenues, if not profits. And if you have profits, it's even better. Okay, so the traditional mindset stays on that front. But whatever happens, however the company does, the investor is clear, boss. At the end of the day, I have to exit and make a killing. That's the only reason they do this. And one of my mentors had told me that when his company got invested in, it was by a big venture capital fund, and they told him that, boss, we have invested money in you. Now you have to give your life to the company. Okay? So it's like that. And I'm saying this because most founders start companies because they don't want to be held accountable to somebody, to a boss in a job, which is why they start companies. A lot of times that's the background context. That returns when you have an investor. Okay, because they will say that I have put in my money in this and you have to give your life. So while your career, everything, the freedom that you have in your life is at stake, you have to be like fully clear about raising that investment. What are the instruments that investors take up, right? To to minimize their risk, or is it what? To maximize profit.
Let's talk about both of it. Let's talk about what are the possible.
So equity is great, right? Plain vanilla, nothing fully at risk, fully risk of upside and downside is both there. But through some of the clauses like liquidation preference and all, you might be able to uh, enhance the amount of return the investor can get. Only risk is if the company is not doing so well, you go down just because the valuation of the company is linked to the equity. If it's doing well, then you can enjoy the money, which is why you have other structures such as convertible preference shares and convertible debentures. These are called hybrid securities because since the word convertible is there, so they can be converted into debenture or preference share. Okay. Yeah, the other is preference share, but pure preference shares. Uh, so it's called a redeemable preference share. That's what a pure preference share is. There you have to pay an interest, okay, and it gets redeemed. It's called an RPS. So, so you have the rights of a preference shareholder. Usually, the more common one is a convertible preference share and a convertible debenture. Why? Because these convert into equity upon the happening of a certain event, or upon the happening of or upon the lapse of a certain amount of time. At that time, it has to mandatorily become equity. Okay, so only until that event it has the characteristics of debt. So all the interest and all of that will be payable. After that, it becomes equity. So that way, you know that okay, you have the opportunity to hedge your risk a little, and if there's an upside, you will benefit from it eventually. Okay, the best instrument people may want is an optionally convertible preference share, but because India's FDI regime allows only compulsorily convertible preference share and compulsorily convertible debentures, uh, optional preference shares and optional debentures are more easy to issue in only a domestic investment, not from a foreign investor. Okay. Uh, I will not go into the difference between the two because it will get too complicated. Broadly, we'll keep it like this. Optionally, convertible preference shares and debentures means that you have the choice as to when you want to convert, whether you want to redeem or convert, which you don't have in compulsorily convertible instruments. You have to convert upon that event. Yes, there is an exception. There can be a default, and at the time of default, before you convert it, the exit related provisions can trigger, where the founder has to pay you back. Okay, those provisions can be triggered in case of a default, but otherwise it converts. Optionally convertible instruments, you have that choice. Okay, so that's why it's better for you. That's the best thing that you want because you can enjoy your debt, the benefits of debt till the time you want, and you can enjoy the benefits of equity till the time you want. Okay, the the next instrument is a non-convertible debenture. Okay, you can also call this. So there's a lot of debt that is being issued nowadays. Venture debt it is called, and a lot of times private equity funds are registered as NBFCs and they give you NCDs. Okay, which is basically that it is pure debt, but it's of a huge amount. Okay, and in an NCD, but you will not have an upside. Okay, you will have to give a pure return as an interest. Okay, and if it's a debenture, convertible debenture, then there'll be an upside. The other share is called last one I'm saying is a convertible note. So when you get your first round of financing, when a business starts and you want to raise your first level of financing, you don't know it. There are various difficulties in actually valuing the startup. It's not easy to figure out how well the business will do. So what investors say is that, boss, I'll give you this money, but I have no idea as to how to value your company. So in that case, we will value this at a certain discount from the next round of investment. When you raise the next round of investment, that time we'll figure out what the valuation is and we will accordingly get the shares. Right now, you issue us a note. This was started at Y Combinator, the famous US startup incubator headed by Paul Graham. Okay.
So, Abhyuday, in
Yeah.
such a case, before you continue, in such a case, what is the return value of the investment that's being made by the investor?
So this is very interesting. Like a lot of times, when you see contracts, many times they are watertight and very detailed, and on many occasions they are sort of more open-ended. And in that way, contracts do work on trust and they do leave things open ended on future performance. So convertible notes are actually, they sound more complicated but are more simplistic. Their document is much more simpler. Okay, so apart from payment of the money back, the year on year and all of that may not be written. Okay, it completely depends, and it's just saying that what a convertible note instrument needs to say is this much money I'm investing, and in this much time it should be, if you raise investment, I will get shares based on a discounted price. So that's my clear profit, right? If I raise investment at 100 crore valuation, okay, and I'm, let's say my face value is 10 rupees of the share, but the investor is giving at 1000 rupees per share. So I get, let's say, at a 30% discount, which is I'm getting at 700 rupees. So that 300 is straight away my profit. Now I have to raise that second round maybe in 1 or 2 years. Okay. So on 700 crores, I made 300 crore profit, which is like a 40% in 1 year. That's the game there. Okay. And once the second round happens, at that time everyone gets a shareholders agreement. That is the big, fully blown up, fully drawn up agreement which has all the clauses. Okay, a convertible note is more like an interim sort of arrangement.
All right. Abhyuday, before we move further, I will take up a question from Tushar Verma, who wants to know that if you can quote the Flipkart deal as an example, as everybody is saying that the exit of the Bunsels is a commendable job. He wants you to, correlate the two and tell us what was the arrangement like.
uh, I'm not updated with the latest one. Both, from what I last read, both of them are not exiting. One of them was planning to exit and the other one was not. Okay, I don't know if that has changed, and it's still like there are still rounds happening, so it's on the move. So I don't want to discuss it as of now like that. Okay, but is the part on the founder exit that he wants me to discuss more?
I think so. I think that's what he's pointing at.
Yeah, because it is one of the first full blown and the biggest, one of the biggest exits in the Indian market. You don't get to hear of them so often, like of a company which grew as a startup and then the founders could have an exit. And this is the kind of exit any founder really dreams of when they start up. Okay, so that way it's great. Otherwise, you keep hearing of Silicon Valley exits. You can hear of WhatsApp being bought out. You can hear of YouTube being bought out. But such a big level, at such a big level, we've not had an Indian exit. And Flipkart's valuation is around $20 billion, and that also is a very small fraction of the amount of Walmart's balance sheet. So that really proves that you can really make a big business and you can still have a really big buyer out there. And there was a time when Amazon got into the Indian market with a 1 billion investment, and at that time Flipkart wanted this kind of 5 billion. Sorry, Flipkart wanted valuation in excess of 10-15 billion. Okay, and Amazon came into the Indian market, and I think they were discussing, they wanted to be invested into by Amazon, but they didn't get that. And the idea was that Amazon could just put in another $1 or $2 billion and then take over Flipkart. And that really didn't happen. And now Amazon is putting in billions more into India to compete. And it's still at a number two, like Flipkart is number one. So that's the interesting part. I think the lesson to learn is that if you do a good business, it's not so easy also to replace you. Because Amazon is clearly the biggest world's e-commerce company, but they couldn't replace Flipkart, and it was because of the little head start that Flipkart had, because was started by ex-Amazon employees, but they had a good, I think, 6-7 years of head start, and that really counted. So these are the things that I know, but the final commercial terms, because they are still not fully finalized, I'm not going to comment on it.
All right, Amrita, we also have a question from.
I can, however, say how the deal structure works. Okay, that might help.
I think we keep that for later for now because we have a couple of questions lined up for you.
Okay.
We right now have a question from Smita Singh. Her question is that what is the stamp duty payable on agreement to sell shares? Is it the same as the sale of a movable property?
I don't know this offhand. I need to check that because it varies, and shares are usually movable property. So the stamp duty that is different is only on issuance of shares or which is share subscription, okay, and on the share certificate. These are the two things on which there's a different this thing. Sale of shares does not usually have a specific entry in most state stamp acts, so it would be the same as movable property. You have to just look by chance if there's sale of security kind of entry. Just look for that. If it's not there in your state, then it would be movable property.
All right. Abhyuday, you were talking about the various instruments that are available for an investor to maximize his profit and to avoid going the downhill. One of the ways is hybrid securities. What are they, and can you give some examples of what hybrid securities essentially are?
Yeah, I just discussed it in detail. It was optionally convertible preference shares, compulsorily convertible preference shares, optionally convertible debentures, compulsorily convertible debentures, convertible notes. These sometimes they give warrants. Warrants are basically options to purchase shares. These are the hybrid securities that are there.
All right. Abhyuday, we'll quickly move to the next question. That is, you talked about that, an investor's basic intent is profit maximization.
Yeah.
How is the profit of an investor calculated in the course of the business of a certain startup or a certain entity? How is the investor's profit calculated in the first place or
So
measured?
investors' profit, the profit that we are talking about, this only happens when the investor exits. Okay, so it is basically there was X amount of money that was invested, let's say 100 crores, and at the time of exit, what is he able to get for his full stake? Okay, that is how it is calculated. And if you have income tax law, in case you have held the property for more than 1 year, there is some concept called indexation, which means indexation is a way of inflation adjustment. So your investment of 100 crores will probably be equal to 150, 140 crores after certain years, and your return will have to be adjusted against that cost price. That is your profit based under tax law. For your commercial calculations, it was 100 crores and you're getting at the time of exit, say 200 crores. So the difference is the profit. During the phase of the investment, when you have not exited, usually there is a freeze on the payment of dividends and all of that because all profits are to be paid back into the company. Founders are basically all profits are not to be distributed. There are often no profits, okay, because the company is expanding, so all the revenues it generates are put into are invested back. Okay, founders don't get a dividend; they are getting a salary, and they may have an expense. They may have a incentive, performance-linked incentive, which is like their bonus, and that's an expense for the company. So no one makes any profits here until there's an exit.
All right. Abhyuday, the next question that we all want to know is that what is you initially in the initial inception of the show you spoke about there are certain liquidation preferences. What
Right.
is liquidation preferences and what is its relevance in shareholders agreement?
So liquidation preference is only there in shareholders agreement. People tend to confuse it with the winding up scenario because your Companies Act and now your insolvency and bankruptcy code has a hierarchy in which payments have to be made in case you are not able to pay your debts and there is a winding up situation, right? So there is that hierarchy which is there. So this liquidation, and that looks like a liquidation preference, but that's different. And this liquidation preference in an investment agreement is an entirely different thing. Okay, because no matter what an investor does, if he has an equity share or a compulsory convertible debenture, he cannot get priority over tax law payments, employee payments, statutory dues, all of that, because those have a higher order, okay, under statute. But while the business of the company continues, at that time, if the founders are to exit, the liquidation preference clause says what is the multiple that the investors are to get on their investment. Okay, that is what the liquidation preference is. That let's say I will get 2x or I will get 3x. So then between the founder and the investor, that adjustment has to be made. So maybe you get a deal, the investor gets a deal where both the founder and the investor are being bought out, okay? And the company is 100 crores, investor has 30%. So investor gets 30 crores, founder gets 70 crores, okay? Now assume the investor had actually invested 15 crores, right? But investor wants more return, wants 2x liquidation preference. That means it wants 30 crores plus 15. That is 45. Okay. They'll explain whether it's 2x or 3x. But let's say he wants 45 crores. So then it has to take the balance from the founder just by virtue of this liquidation preference clause. The founder was getting 70 crores. Usme se you reduce 15. So founder gets 55, investor gets 45. That's the beauty of a liquidation preference clause for an investor. So liquidation preference can say this, or it can say that it will ensure that the IRR is provided, internal rate of return, say 20% per year. That is the minimum that's provided in case of an exit. So many founders think that investor ka paisa wapas kar diya, that's great, or oh, I found an exit for an investor. But that's not enough. Just having a buyer for your investor is not enough. Just ensuring that he or she gets a higher valuation and therefore there's a capital appreciation also is not enough. There has to be a gain in valuation which is proportionate to your contractual commitment that there should be this much gain. Okay.
All right. Abhyuday, the next question that I have for you is that what are the protective rights and what are the anti-dilution provisions under a shareholder's agreement?
Hey, we already discussed protective rights in a great. Okay, I discussed all the set of protective rights. The only thing I didn't discuss in detail is affirmative voting rights. The others are preemption, tag along, drag along, right of first
Yes,
offer, all
yes,
of
we
these
did
rights.
discuss all of that. We can talk simply about.
Affirmative voting rights are on matters where there's a significant amount of expenditure or further issuance of shares or taking a loan or initiation of a litigation or there is something related to intellectual property or an expenditure above a certain amount or a certain kind of business change in your business. Okay, these are broadly the heads, and the list can be small or big. That can differ. Do make it a point to go through the section. In every contract, it's very different. So go through the part which has affirmative voting rights clause, but this is the general tenor of it. Now, in these heads, based on the business, you can have more subheadings.
All
Okay.
right.
Yeah, these are affirmative voting rights. The second part you were saying was what is
Anti-dilution. Anti-dilution.
anti-dilution. You have to see it's of two types. People should not mix it up. One is a simple this thing that when you issue further shares, you need to give me an equal opportunity to subscribe. You need to give me a priority to subscribe because I am an existing investor. So you can't dilute me by issuing shares to someone else. Okay, that is the basic one. uh, the real anti-dilution in context of an SHA is that if the valuation of your company reduces, okay, in that case, what happens to the existing investor who invested at a higher valuation? Basically, he has to be brought on par with the reduced valuation. So this happened in case of Red Bus, for example. In one of the rounds, their valuation reduced. Okay, and so an existing investor will want compensatory shares, which is shares at a much cheaper rate. So there's a full valuation adjustment, and more shares are issued to the company. To the investor, to the prior investor. The new incoming investor has already subscribed at a lower valuation. So anti-dilution always happens when there is a older investor and a subsequent investor. There has been a drop in the valuation of the company at the subsequent investment level.
All right, got it. Okay, Abhyuday. So now that we've discussed this, and we've also discussed that what happens in the case of valuation if the valuation decreases. My next question to you is that in such a case, how can one ensure that the founders are committed to the company's growth? What if in the due course of the run of running a company, the founders lose their interest or they are probably working on some other project or any circumstances? How can we ensure that the founders are on their path of what was decided by the investors?
So there is the business way and there is the legal way, right? And if a person doesn't want to stay committed to something, you can't do anything about it. Nobody is your slave. But legally, what you can do is prevent them. There will be a contractual clause, no, which says that founders will not do any other business. They will commit full time to that business. There will be a non-compete that even after they exit from for 1 or 2 years they will not operate in a similar space. All of this will be there. Founders will not earn anything because they'll only get salary and bonus. So, from a perspective of their economic needs, they may be fully committed. They may be kept fully committed like that. I cannot say how long that will last or not last, because let's say an investor's hunger for growth may be much more than that of the founder. So the founder may be happy at a certain level. But yes, there is a pressure that is put by the provisions of liquidation preference, which will say that, okay, in 5 years or 7 years, we want an exit by 20% at 20% internal rate of return. So that is there. Beyond that, now if the founders fail, what will you do? You will have a personal indemnity from the founders, but they will negotiate it out, and if they are well advised. And in that case, for the sake of business, you would go ahead. So if a founder really loses interest, there's nothing you can do, which is why a huge section of private equity and venture capital investments fail. Probably 80-90% fail. And the ones that succeed like anything. That's why.
In this course of conversation, it almost feels like that, when you get an investor to invest in your company, you're almost, or more than that, you're giving your entire ownership of the company to the investor and becoming just another regular employee in the course of your own business. In such a case, my question to you is that in happening of such an event, how can one negotiate the various clauses that a shareholder agreement already has?
So you're asking from a founder's perspective. So
Yes.
you will get the indemnity out. Okay. You may get the liquidation preference and the IRR clause out and say that I will give you at whatever the valuation is at the time of exit. You may remove the founder's lock-in and say that I don't want to have any lock-in, or I may have a very small 1 or 2 year lock-in, and after that I can ensure I have majority stake, but I may dilute up to, let's say, 20-30% of my stake for my cash needs. Okay, this much may be there. I don't think investors will be very comfortable with a founder starting other businesses and all of that. So no point trying to argue that I don't want to be doing this business full time. You will not get investment also.
All right, but Abhyuday, tell us something that, see, from where I understand it from, is that most of the startups and the businesses that are looking for investors are desperate. They just want to get an investor, come what may. In such a case, how much bargaining power they even have in the first place to negotiate the clauses of a shareholders?
Actually, if they replace the desperation for investors with the desperation for customers and revenues, a lot will change, because their need for investors will reduce, but their bargaining power vis-a-vis investors will increase. Their investability will increase. Okay, because if you are going for investors, it becomes a very roundabout way. That you are first looking for investors, then you have to make a product, and it really doesn't work like that in the Indian market. You have to have your product, customers, revenue, and then you can think of investment. Okay, and whether you have a bargaining power or not depends on how many investors you've gotten interested in your business. If you have a business which is growing, which has revenues and users, even if you don't have profits, investors will be interested. There are actually, I must tell you that investors really get interested when they see growth and they see passion and commitment of the founders. How do you demonstrate that? You demonstrate that by having been involved in your business over a period of time and growing it from one level to another, which means that the moment you have your business idea, it's not a good idea to straight away run to investors. You need to build your prototype, start playing the game, because real commitment has to be on the test of, has to stand the test of time. Otherwise, whatever you're saying is only made up for the moment. Who knows how long it will last?
All right. Abhyuday, final questions for the hour is that how can one ensure that the investment is protected? And in case there are opportunities to exit on the happening of specified event, how can one take that exit option?
So, how to stay protected, I have already discussed. Okay. If there's an opportunity to exit, you're talking from founder's perspective or investors, that needs to be seen. But basically, the founder and investor need to get in touch. There are notification provisions that I want to exercise my ROFO, they issue a notice and all of that. If there are good relations, you will first have a conversation and then you will issue these notices. And then founders will figure out with the investor that whether the investor wants to tag along, what is the kind of valuation they're getting. They can collaboratively work and then negotiate like that.
Abhyuday, because we have some time left, let's talk about let's go back to the Flipkart deal and talk about the various intricacies of the deal that you were about to discuss at that point of time.
Right. So let's discuss a founder exit situation. A founder exit situation usually happens after a series of investments. You will not be exiting immediately. Okay. Unless you are acquired and the company has absorbed you and they don't need the founders. Okay. Otherwise, founder exits are usually much more delayed, especially if you are a big company. Now, how does that happen? So shares of the current company will be acquired. So shares of Flipkart in this case will be acquired by Walmart. Now, how do these get acquired? So Flipkart wants money, right? So Flipkart has to issue shares. So there's a subscription happening there. When you are having a investment, you are having a share issuance by the company. So company issues shares and gets money. That's how Flipkart gets Walmart's money. A part of the transaction, on the other hand, goes to finance the exit of the shareholders, of the founders. Okay, so it gets split into two parts. Now that money the founders get and the company doesn't get. A lot of times there's a price difference in the price at which the investor or the acquirer acquires the exiting shareholders. Okay, it really depends. They may acquire at a lower valuation and the investment may be at a higher valuation. Why? This company needs the funds. Okay. Sometimes you may even have the investors selling. Sometimes you may have the founders selling at a premium. They'll say, I'm selling off control to you. I'm going to sell off at a premium. Okay. That really depends on the situation. Now, when the founder is in this way, the founder shares are acquired. Companies have a transition arrangement where the employment arrangement of the founders continues for about 1.5 to 2 years. So it's a simple employment agreement where the founders are to help with all the transition. You may have that with one or multiple agreement or for multiple founders. There is something called an acqui-hire. Okay, in an acqui-hire, what happens is that the startup is acquired, but it may or may not be for a heavy valuation. But what really happens is the startup's team is absorbed in by the company, by the acquirer. So assume if all Walmart was to do was absorb Flipkart's team and not pay a substantial consideration for Flipkart. That will not happen in Flipkart's situation. But in a case of a lot of other startups, that can happen, right? You started your business and now, fine, it's not making money, you're not making a killing. But what if you could have a well-paying job? Okay, what if your business could be absorbed into a bigger business? Okay, sorry. So in that case, that is called an acqui-hire arrangement where the whole team gets, or at least the founders get acquired, and they are on an employment agreement with the acquirer. They may get some small percentage of shares or ESOPs of the acquirer, but basically they get a job at a much higher, better level with a bigger company. And that's also a way of saying that your startup is successful. It's in no way like less than this.
All right, Abhyuday, that was an hour with LawSikho for today. Any closing thought that you have for the last 1 minute?
No, man. Every time I look at shareholders agreement, something new comes up.
Yeah. All right. Anyways, Abhyuday, thank you so much for your time and again, great efforts that are put in this show. Thank you so much, everybody, for watching.
I'd love to have questions, by the way. Sorry, that's all I want to let everyone know. So, in case they have questions, they can write to you or directly to me at Abhyuday@iPleaders.in. That'll be great.
Yes, that is what I was coming to, guys. If you have any suggestions, doubts, queries, or certain topics that you specifically want us to cover in the coming week of an hour with LawSikho, please do write into us at aditya@ipleaders.in. That is ADITYA@ipleaders.in. We are more than looking forward to your suggestions. Thank you so much for your time today. We'll catch up tomorrow again. Tomorrow we have somebody great. We have Ashish Bhakta for you, who is the partner at A&B Legal Advocates and Solicitors. He'll be talking about private equity and career opportunities in it for various lawyers and law students like you. Do not miss that session. Thank you so much for watching us today. Do share, do like, share, and subscribe. Hit the bell icon for more notifications as we are going live every Monday to Friday, 8 to 9 p.m. This is me, Aditya, signing off from an hour with LawSikho. Till then, out, LawSikho.